And then last but not least, that high cash value policy, whether it's an index universal life or a whole life policy, those policies have some slight differences, but again, it works like a Roth, very similar. You're putting in contributions, i.e. the premium, into a plan after tax dollars. The policy cash value wise, compound interest grows tax free, and then it's liquid and is able to be used during your lifetime. That 59.5 restriction is not there. And then you can use that cash whenever you want, wherever you deem necessary. And then potentially in the future, supplement income with this as well that continues to be tax-free. So that is a true tax-free plan that can be utilized. And it's a great strategy and a great foundation to kind of get things jump-started with your asset portfolio.
So let's rank these from top to bottom, because we just had a conversation about the HSA possibly not being a tax-free income vehicle, just simply because, like you said, it has like a triple tax strategy that people think of, where it's tax deductible immediately, your money grows tax-free, and you can use it for only medical expenses. But then if you do not use it for medical expenses, when you hit a certain age, it acts like a traditional IRA, and you would be taxed on everything that's within that plan. So it's really not the best tax-free income vehicle. I don't know if you would call it tax transfer. Like you can actually transfer that money and use it for medical expenses. But the reverse mortgage is considered a loan. So that's why it becomes tax-free. Similar to the life insurance piece, they're just holding your equity as collateral and loaning you the money. So therefore, because it's a loan, it's not income, which gives you the ability to not owe taxes on the money that they're giving you, because they're loaning you those funds as they're loaning you the money instead of giving you the money. Therefore, it's not any kind of payment you're receiving. That's why you don't owe taxes on that money. Correct?
Yeah, it's definitely in essence a loan because it's going against the property. So when it sells, you're not getting all of that money back like you traditionally would if you remained or retained that equity position. So yeah, that's correct. So yeah, the HSA, when they say income, I mean, I would classify that as the fourth out of these particular four that we're describing here, because if you are needing that supplement for medical expenses, you don't have to pull from other income to make those payments. So in theory, it is an income that's coming to you from a medical perspective. So it is tax-free. But as you stated, if this has to be flipped as truly turning this on as an income versus just medical expenses, that becomes a taxable event. So I would classify that kind of rank that as the fourth. I would go reverse mortgage as 3. I'd go that qualified Roth distribution as 2. And then I would go as the high cash value policy, IUL or whole life as 1. And the reason I don't flip the Roth to 1 and the life insurance 2 is because of the 59.5 rule of not having access to that money until that age. And then in addition to that, there's still the positive versus negative of the market of how you have that money allocated in the Roth. It can still lose, whereas the policies cannot in terms of the life insurance policies. So that's why I would make that 1 versus 2 in the Roth versus the IUL.
Yeah, I would give it the same ranking. HSA 4, reverse mortgage 3, qualified Roth 2. You know, not only what you mentioned about the Roth, but also you've got a limit on what you can contribute into the Roth as well. So being capped out, it's a great vehicle for someone who's, I guess, would be making less money, because their full retirement investment that they're putting back, that savings, it can actually fit within the Roth. But if you're a high income earning individual and you're trying to look for a place to put money that can grow tax free and you can utilize later in life tax free, then you're going to be limited on what you can actually put into the Roth plans versus a cash value life insurance plan. So let's go in depth a little bit more on the number 1 and best non-tax income vehicle out there, which would be the tax-free retirement, what we call tax-free retirement. with the IUL or cash value life insurance. I mean, there's really nothing out there that functions the way that cash value life insurance can function and can create a tax-free retirement for you down the line. These policies can be very big or they can be very basic. And the growth within the policy, one of the key things that Ron, I can't remember if you mentioned or not, one of the key features, and I want you to kind of explain this to them in a way that they can understand, but you can actually access the money over the course of the life of the policy. So when we talk about life insurance, a lot of people think about death insurance, which is when you pass away, this money is left behind. The life insurance within a high cash value policy or an IUL, it is designed for you to use while you're living, while you're still alive. So speak to them a little bit more in detail about how you have liquid access to your funds versus a Roth that's locked up until you're 59 and a half, or a HSA, even if you're going to draw income off of it, it's still locked up until you hit retirement age. And even the limitations of a reverse mortgage, it's the same dynamic. The younger you are, the less equity they're going to give you, meaning the less of a payment you're going to receive. The older you are, the more of a payment you're going to receive, but you're still limited to only receiving a piece of your equity at a time. Whereas with the cash value and IULs and life insurance policies, you've got access to the full balance of your account. I think there's limits, maybe 80 to 90% that you want to withdraw at one time, but you still have liquid access to where you can utilize those funds while you're living. Explain that to them.
Yeah, it's truly becoming your own bank, honestly, is how that has to be viewed. Because you can exercise this, there's not limitations based on age, which most plans, if people are familiar with most of what they're involved with from a retirement perspective, most of their plans have an age restriction. That 59 and a half rule is pretty important when it comes to qualified money, like IRAs. Roth IRAs do the same thing, 401ks, 403bs, those types of plans are age restricted. So with a high cash value policy, it's not age restricted. It can literally be used throughout your lifetime. It's a living benefit, in essence, is kind of how you kind of look at this. You're prepaying a death benefit, more for simplistic terms. So if you have cash value that's built up, what's happening is it's a compounding interest. So anything that gains come in, it's stacking one on top of the other, $1 on top of another. So if you're building cash value, whatever returns are happening, that becomes your new floor. So what I mean by that is it can never go below that ever again in terms of the value of the cash, because it's protected against losses. In an IUL, the Index Universal Life, it's protected from losses. So you're protected, you're participating in the market versus a whole life plan where you're getting dividends returns. It's not participating in the market, you're getting dividend returns. But again, there's a floor. It can never go below where you were the year before. So any gains that are happening are being attributed to what the new balance of your cash is. So if it's $100,000 of cash one year and you gain the next year, you gain, let's say $10,000, it's $110,000 the next year. The growth is off the 110, not the 100. So it continues to compound year after year after year. The dividend works in a similar fashion on a whole life policy where it's 100, you get a 6% or 7% dividend, let's say, that's $6,000 or $7,000 off of 100. That next year it's 106, 107, depending on that percentage of dividend. Then that next year, if it's 6 or 7% again, it's off 106 of that value to go up. So you're getting that compounding interest that's going up year after year, but your plan is completely protected from any losses that occur in any fashion within the markets. Being able to access the funds, you can utilize it to buy vehicles, college education for children, supplement income in the future. You can buy cars in this fashion. You can buy real estate in this way. You can do things with your own primary residence. It's truly your own banking system to make $1 act like 2, 3, 4, 5, depending on what you're trying to accomplish within your life. And the value of this is you're taking a loan like you described, but it's not a loan from you. This is kind of the fallacy of what people don't understand, I don't believe, with the policies. You're taking a loan from the insurance company. They're giving you the money against the collateralization of your policy, meaning if you pass, you don't get, the beneficiary doesn't get all of that death benefit if there's money that's been loaned or borrowed against. So that gets reduced off the death benefit because you've in essence have prepaid your death benefit. But the beauty of it is if you have $100,000 of cash and you take $50,000 out to maybe invest in a real estate property that's giving you passive income month after month after month, and we can teach you how to do these types of things where you can pay yourself back over time. This is the beauty of this. And at the same time, you're not losing the earning potential, the earning power of the dollars that's sitting inside your cash value. So in other words, that 100,000 is no longer available to borrow against all 100 because you've taken 50, but the growth is. So the growth is still being attributed to the $100,000 because you've taken it from the carrier, not your policy. You just have the 50,000 that you've taken and you've used. So you don't have full $100,000 availability of cash. You have 50 to use still, but the growth goes off the 100. This is where this is the major difference versus any other product out there. You still are growing as if you've never touched the money. You do that in any other asset plan, you lose that money and earning potential on that money going forward because it's not there. You take 50 out of an IRA or 50 out of a Roth or 50 out of a mutual fund, that's gone. You don't get the growth on that anymore. This plan does that. That's the major difference in terms of the growth, but the taxation is huge because you don't have to explain why you're taking the money out and you don't pay any income taxes. So this doesn't hit a credit report, nothing along those lines. So when we say act like a true banking system, that's what it really does. So when you look at the comparisons and things that we just talked about, the reverse mortgage, the qualified Roth distributions and the HSAs, the Roth distribution does the same thing in terms of tax-free, but you don't have the availability of cash at any point in your life until you've passed the age of 59 and a half. That's huge. Then the HSA, only for medical expenses, except when you get in retirement, then you can take distributions for income, but then it's taxed as ordinary income. So it's a major, and again, the reverse mortgage, there's no taxation, but you're taking equity from the property when it goes to sell. And you can sell it prior to you passing, or your heirs can sell it when you pass to get whatever is necessary out that you haven't borrowed against. So again, you're not getting the full value out in that particular plan. You're just helping supplement income because you need the money. So again, when you rank these kind of things, this high cash value policies are the way to go when you want to keep money in motion and not let it just sit and accumulate and hope it achieves a dollar figure in the future.
Man, especially if you're a high net worth individual, if you're in a higher tax bracket and you wanted to take money out of one of these traditional plans, dude, you're going to be taxed 30, 40% on your income that you're drawing off of those plans. So the tax savings, to your point, is really beneficial. And it's the only vehicle that acts this way that you can actually utilize in this manner. And we've recently looked at different scenarios, where actually right now in the economy, we've got a lot of people taking money out of their 401k because inflation is going up. There's emergency medical expenses and emergency expenses that families need. I mean, things are rapidly getting more expensive every single day. And this is why we see the Fed has hiked interest rates super high to try to control inflation, which it hasn't controlled anything. People are still spending money. Credit card balances are higher than they've ever been. And more people need to know about these true tax-free vehicles, to Ron's point, that function like a bank, that you can go in and utilize your cash whenever you want, put it back,